Inventory or stock refers to the goods and materials owned by a company, with the goal of selling them to their customers, such as the merchandise that is sold through a company's stores. But merchandise is not the only type of inventory. There are three main types of inventory: raw materials, work in progress, and finished goods. Raw materials are materials and supplies used in the production of finished goods. They are not intended to be sold on their own by the business, but rather transformed into final products through a manufacturing or preparation process and then sold to customers in the form of finished goods. For example, a coffee shop that sells coffee beverages to the final consumer would stock raw coffee, sugar, and other ingredients used in the preparation of the final beverage. These ingredients on their own are not sold directly to the customer. Instead, they are considered raw material type of inventory. The second type is work in progress, sometimes also called work in process. This can usually be found at businesses that manufacture their own products. At some point, some of these products have still not completed the manufacturing process to be considered finished goods, and at the same time, they are not raw materials anymore. These are recorded as work in progress or work in process inventory. For example, when you look at this balance sheet from P&G, you will find that the company has listed the three different types that together make their total inventories: materials and supplies, work in process, and finished goods. The last type of inventory, and the one most commonly used in retail and e-commerce businesses, is finished goods. This is what we refer to as merchandise, which is the products that are ready to be sold to the customer. Merchandise is considered an asset and is reported on the balance sheet under current assets because it can be converted into cash within 1 year. Merchandise that gets sold within a reporting period also gets reported on the income statement for that period. The retail value of the sold merchandise is recorded under revenue, and the cost value is recorded under cost of goods sold, or COGS. Together, both numbers are used to calculate the gross margin of the retail business. Merchandise goes through a cycle within the retail business. This is called the merchandise flow cycle, and the process of how this inventory is managed throughout this cycle is called inventory management. We explain how to manage inventory throughout the different stages of the merchandise flow cycle and what reports to generate and use to manage inventory efficiently in the merchandising and inventory management course. Combine it with the retail math course, which is a prerequisite that will show you exactly how to calculate all the sales, inventory, and financial metrics used in retail and e-commerce, and how these metrics connect to each other and get used in the day-to-day management of a retail business. You will also find implementation frameworks, professional templates, and online tools that you can use to plan your merchandise and stock the right level of inventory. And at the end of your learning journey, you will go through the Retail Business Performance Analysis course to see how your process of managing inventory reflects on the financial performance of the whole business, and how the top management, investors, and analysts see such performance, and what sales and inventory reports you can generate based on the final results to go back and fix any problems related to inventory. Check out all these courses and resources at the Professional Retail Academy. When inventory enters the business, gets sold, and turned again into cash, this is called an inventory turn. And the rate at which a business turns its inventory in a year is called inventory turnover ratio. Inventory turnover is an important metric for a retail or e-commerce business, one that is closely watched by investors and analysts. You can learn more about inventory turnover by watching this video next.